Hello traders, the title of this video is how to trade breakout using Elliott wave part 3. This series of videos are recorded by Georges Beaulieu, a founder of www.24elliottwave.com. Our goal is to simplify the wave theory without diluting it. In this video, we're going to discuss breakout trading using the first Elliott wave extension. In the first part of the video, we were talking about the fifth wave extension. The second part of the video, we were talking about the third wave extension. Now, one thing we need to understand, the first wave, the third wave, and the fifth wave are impulsive wave. So, to trade breakout successfully, one must find, an impulsive wave. An impulsive wave will break a resistance level, or will break down below, will bring the price below a support level. So, as we have seen before, I've told traders many times, the signature of the first wave, is a breakout out of a resistance level. One of the Elliott wave that usually will break out of a consolidation zone is the first wave. Boom. Alright? So, very often you'll see that's the guideline for wave counts. Alright? Now we are talking about breakout trading. Alright? So, when we are talking about the first wave, we know that the first wave can be extended. The first wave is extended when it's formed of 5 minor waves. 1, 2, 3, 4, and 5, So 1, 2, 3, 4, 5 waves, The first wave, the third wave, and the fifth wave are what we call impulsive wave. First wave, second wave, third wave, fourth wave, fifth wave form what we call the motive wave. Alright? Now, the motive wave is the trending phase of the price. You want to know where and when do we see a motive wave? The motive wave usually takes place after a corrective phase, because the Elliott wave cycle is what? Motive wave, correction, motive wave, correction. Or sometimes we can have a complex corrective wave, which means we can have a triple, zigzag, or other complex corrective wave. So the correction may last, may be long. Like you can see for this Cisco stock, you see the correction was taking place since 2001, consolidation. 2001, now we are in 2013, the price is still in a consolidation phase. This is a correction taking place. You see the first correction down, and then blah, 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 we are still here. Alright? So, a correction may be very long or very short. But when traders are looking for correction, they think that it's just a normal correction where the price pull back. But there are different types of correction. Sometimes a complex correction can take place. A zigzag, a triple zigzag, a double zigzag, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, X, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, X, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. Alright? So a correction can take a long time. But when we are talking about the first wave, as you can see here, Cisco stock is consolidating for a long time. This is a correction taking place. Very often, if the correction is completed, which means we're going to look at the internal wave or the correction that is taking place, so we can ascertain that the correction is now finished. The dust has settled, a new management is in place, the market environment is improving, the sector is about to improve for Cisco stock, alright? There's something going on for this stock, there's a hope. The market decided to reevaluate this company, alright? So the price was first, now Cisco a few years ago went all the way to $80. Today it's at $21. There's a new valuation that has taken place after this sharp correction, and this correction over many years. So there is a discussion going on a new evaluation going on. That's why we see this consolidation going on. You see here, the price went above this resistance here. All right, all right. So we will say at this point in time, because the first wave must always break a resistance level. All right, when above it, yeah, come back down, and then blah blah blah. Here we are again. So this session here, that are the green line and the blue line is a consolidation. If there's going to be a first wave, it has to break above the consolidation level. All right. Talking about breakout trading using the first wave extension, very often the price will have difficulties to come out of the consolidation quickly. So you will see the price will go one step, hit a resistance, pull back, went up bullishly, and then pull back, and then finally you see, and it will be formed of a 1, 2, 3, 4, 5. This is a complex first area wave that will dig out, the financial instrument out of this rubble of a consolidation session. All right. So sometimes you may see a beautiful breakout during the first wave, which means we see the price will come like this, one. All right, I'm moving my line. Okay, you see the price will come one, and then you will see it like this, and then it will come again a two, or sometimes the best scenario is you see it will come like this. Very bullish stock will come one step straight out of the consolidation like this. People will say, this is the first wave. All right? And then the market will say, well, it's first wave, yes. But the first wave is not finished yet. And the price will pull back deep a little bit inside the consolidation and then run. You may see this on a weekly chart, on a daily chart, and you may say, okay, two. And people say, well, the third wave is beginning here. So this is the problem with the first wave extension. Sometimes if it goes on for too long, people will think that, okay, we are in a cycle, but this is just a part of the cycle. The wave patterns are fractal. All right? So as the price went out of the consolidation of this, because there's nothing wrong with the wave count, because we see breakout of the consolidation, resistance on our left-hand side has been broken, the correction is completed. Okay, now, it break out, we say, well, this is the first wave. We label this one first wave because we are going step by step. All right? This is the problem. Now, sometimes, there's one thing to know about area wave and one thing to trade area wave. Two different things, all right? Two different things. One can know all the theory, but one can have a lot of trouble trading the wave patterns, all right? So as the price, that's why I prefer the step-by-step, approach. So as it comes like this, we say, okay, this is the first wave, all right? And then it pull back like this. So they say, this is the second wave, it is completed. We check the internal wave of the second wave, whether it's completed or not. We say, okay, the third wave is underway. Okay, the third wave is underway. Everybody decided to bow. So there's a breakout here out of the consolidation zone. So what I need to mention here for the first wave breakouts, first wave breakouts, what I want you to understand is that you want the price to come out in two waves like this. 1, 2, and the third one breaking out. Do not use the first one like this. So when we see the price in a consolidation like this, and you push it out of the consolidation like this, don't call it breakout until the second wave is completed. Now, if you remember what I said now, all right, you will avoid a lot of breakout mistake during the first wave. I'm going to say it again. If you see the price, like you see here, push it out of the consolidation like this, all right? One like this. The first time it comes out like this, don't call it a breakout if the price is coming out after a consolidation. So we see a consolidation for a long time, yeah, and the price push it like this, don't call it always a breakout. Wait patiently until the second wave is completed and the price has changed direction. So you want the price to do 1, 2, and the third move to break out. So for the first wave extension breakout, we want the price to go like this, 1, 2, and then breakout here. But this breakout here, we will not be very, very excited about it because that's the first time it's coming out of the box. So it come out of the box, it ran away, and then it pull back a bit. If it did below it again a little bit, and then it's coming out, this one will cut. We will pay more attention to the second time breakout. So the first breakout, just acknowledge it. If there is a second breakout after the first one, pay attention to the second breakout right here. That's a low risk entry point. This is more high probability trade setup, the second breakout. So this is the first breakout right here. This one is a better setup for us because we know now that the minimum price move is what? 3. So the price went 1, 2, we will expect the third move. But be careful. You want to analyze first the second wave. I can't say this too much because it's too important. A lot of traders get into trouble during the second wave. You must understand the corrective wave pattern, the zigzag pattern, to know whether the second wave is completed. So once we see that this, all right, so try push it like this and then do like this, we will expect a better breakout right here. This is critical. So very often, when the first wave is extended, we will see a pattern like this. If I come 1, 2, and then 3, it break out for the second time here. But because as we are here, we are thinking that this is the third wave. Nothing is wrong with that with our wave count because we see 1, 2, 3. On our time frame, now I'm on the monthly chart. On this monthly chart, if I see something like this, the mistake that we will make is to stop on a monthly chart and say that this is the third wave. To avoid this mistake, we will go to the quarterly chart or yearly chart so that sometimes the higher time frame will betray what is taking place. The higher time frame may tell you, may reveal to you that there's a high chance you may have an extension of the first wave. All right? Because of the wave patterns on the higher time frame, the pattern on the lower time frame, a minor pattern, a minor wave, the wave on the monthly chart, a minor wave of the wave of a higher degree on the quarterly chart, yearly chart. So sometimes by checking a higher time frame, we can figure out that this wave is not yet finished, it's going to be extended. So, but if you were on this, if you were on the monthly chart as I am now for this Cisco stock, you will say, okay, it's a third wave, nothing wrong. Nothing wrong, you are going step by step, nothing wrong. So we take it, it went up. So we'll use the projection of this channel, but we will notice quickly that the price, and then quickly you will notice, okay, if you do your projection, it will bring you to the pink line. Maybe the price will push here, and then you see again another pullback. And then trader will say, okay, George, I told you this is, we are now in the fourth wave, and we will expect the fifth wave. Now, I want to say something before I continue. So we see 1, 2, 3, 4, 5. We will say the area wave side, the multi-wave is completed. But if you count 1, 2, 3, 4, 5 on one time frame, that's a multi-wave on that time frame. That multi-wave on that time frame can be a single wave on another time frame. So you may count 1, 2, 3, 4, 5 on a daily chart. That 1, 2, 3, 4, 5 wave can be only, okay, one wave on the monthly chart. All right. So now we see that okay. So it goes up. Suppose we are on a monthly chart. We went like this, and we see a breakout. We check the quarterly chart, yearly chart, and we notice that there's a high chart. We may see an extension. So we see push it, okay, and form 5 waves. But talking about breakout trading, the key thing that trader must remember is that we don't want to take the first breakouts. All right. We want to pay attention to the second breakouts. So, which means the second wave, deep below, okay, the consolidation, the upper level of the consolidation level. You see that very often when we have a zigzag pattern. So price ran out of the consolidation zone and then went down 1, 2, 3, 4, 5. There is no corrective wave from the 5 wave. So we will expect the correction to continue. All right, so we will see 1, 2, 3, and then 1, 2, 3, 4, 5, bringing the price back inside the consolidation session. All right, that's the theory. All right, talking about the zigzag pattern. This is an illustration. All right, and if it come out for the second time, all right, so we'll see 1, 2, 3, 4, 5, and then you see the second one here. Now, for traders that are more experienced, if we see that if you pull it down like this, 1, 2, 3, 4, 5 into the channel, pay attention, and we have the second wave, like, and we see the second breakout here, we need to be careful. Why? Though I said to you the second breakout is more interesting, if this move from here to here is formed of 5 waves, we will be thinking of okay, the zigzag pattern. So myself, if I see this one from the 5 wave and I see the second breakout, I will stay away from it. Why? Because I know that there's a high chance that we may see a zigzag corrective wave, a zigzag second wave, because no correction is from the 5 wave like this. So once I see an impulsive move take out of the the consolidation zone, if this move down is formed of 3 waves, which means they move from here to here, is 1, 2, 3, well, and then it's breaking out for the second time, that's interesting to me. But if I see that impulsive wave break out of the consolidation, and the second wave is formed of 1, 2, 3, 4, 5 waves, bring it back a little bit inside the key resistance level, it may not be exactly on top of the consolidation, it can just be a resistance level that the first wave has exceeded, all right? If we come down 1, 2, 3, 4, 5, before coming out for the second time, I will be careful because no corrective wave is formed of 5 waves. But I will be thinking of a zigzag pattern, so I say 1, 2, 3, 4, 5, what's going on? Well, I will wait. If you go 1, 2, 3, I will sell instead, all right? So expecting another 5 move down. So I will be expecting the third breakout to be more, okay, reliable. So for a zigzag second wave, the third breakout of the consolidation will be more reliable for us because of the wave pattern. So you go down 1, 2, 3. The first one will be 5 wave, the second one will be 3 wave, and the third one will be 5 wave. So I will be expecting my third Elliott wave not during okay the second breakout, but during the third breakout. Are you with me? Okay, maybe. Okay, so the zigzag will come down 5 wave, break a key level, all right, and then we'll be again up for 3 wave, probably go above that resistance again, or may not, or will touch it here. So what I'm saying to you, if we see this move down during the second wave from the 5 wave, and we see the second breakout, we will not be very excited about it because that can be a fake breakout. Talking about the zigzag wave pattern, we'll be careful. Instead, we'll look for opportunity to sell again because we know that the second wave is not completed. But at this point in time, if you do not understand the internal wave or the zigzag pattern, you will think that this is a valid breakout. And you will be get caught, you will be in trouble as they are selling you down for the third time. In that case, when the second wave is a zigzag pattern, we will prefer the third breakout. So, you understand? So, the first wave, brought it out like this, boom, 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 break out of the consolidation zone. But then we have a second breakout here, all right? But because the first part of the second wave is formed of a 5 internal wave, we will be watching carefully because we know that a zigzag is likely to take place. And this second breakout will not be reliable for us. We will stay aside or watch it carefully and not be too enthusiastic about this breakout. This is likely to be a false breakout or a fake breakout. All right? So by understanding the internal wave or the corrective wave during the second wave, we are likely to filter out a false breakouts, okay, at the end of the second wave. So this will not be very interesting for us. We will be watching the third breakout if the second wave is a zigzag. But if we have a normal, second wave, which is formed of a 3 wave, because when we are talking about 3, we are talking about correction. So we see, you want me to remove some line? Okay, let me remove some line. I'm breathing slowly, and I'm trying to make a sense here. And as always, we want your interaction, all right? So pay attention carefully. Pay attention carefully, okay? All right? If you are a new trader, don't just go and apply the strategy, all right? Anyhow, practice, practice. We make you better, all right? So here we are, first breakout of the consolidation zone. So at that point in time, we'll be saying this is the first wave, all right? But the first wave can be extended. That's why we need to be careful not to get excited that, oh, a third wave is underway. But if we see the first wave on one time frame, we must check the higher time frames to validate that setup. So we cannot just assume that this is it, because a wave on a one time frame can be a minor wave on another time frame. A cycle on one time frame can be a minor cycle for a bigger cycle. So you may see 1, 2, 3, 4, 5, 1, 2, 3 on a daily chart, on a weekly chart. But if we have a bigger cycle, okay, a super cycle that is underway, that 1, 2, 3, 4, 5 will be leveled as a single impulsive wave on another higher time frame. Are you with me? Same thing for correction. That's why sometimes we have a double zigzag, triple zigzag, and everything else that we have learned, the wave pattern. That's why I'm saying to you, a lot of traders know about Elliott wave so much, but they don't know how to trade. What we are doing here is how to trade using Elliott wave. It's not about how to know about Elliott wave. It's more about how to know about Elliott wave, but how to know and understand and put into use, okay, the wave principle when it comes down to trading, day trading, swing trading, and position trading, trading stock, commodity, futures, all right? There's a better correction second wave, can be like this. So first wave, and then we see 1, okay, 2, 3, all right? So the rule, one of the rule of a wave count is that the second wave must not cancel the first wave. So we see 1, 2, 3. So in this case, though we see here, there was a first breakout, okay? And then there was a second breakout here. This is a tricky one. Why? Suppose this line here, from here to here, is not divided into 5 waves, or 5 internal waves that we can see on this time frame. So it just went down in one straight line like this. So we couldn't see the internal wave. How do we see the internal wave? We must now go to the lower time frame to zoom into it to see whether it formed a 5 wave. That's how we see the internal wave. If you can't see on one time frame, you go to the lower time frame, zoom into it, zoom into it, zoom into it, until we detect the internal wave, okay, of this move from here to here. Sometimes they probably just go straight line, push down, which make it a bit tricky, because as it's coming out for the second time, we will be watching it, looking for opportunity to buy. But anytime we want to buy at the support level, provided that the fundamentals are solid, and it's also a viable company. Otherwise, stay away from it. It's pointless to apply the wave theory, a bullish wave pattern, to a company that is not going anywhere. All right? So if they can't pay their short-term debt, all right, they are crashing under competition, they are losing market share. Look for another financial instrument. That's all I can say, all right? Look for another financial instrument. Don't just trade it because your software detects a pattern and you want to trade it, okay? Check the economy news, check the fundamentals, all right? So this exercise, you can see that myself, I'm finding it a bit difficult to make it clear to you. As you can see, the first wave breakout is a bit tricky for a lot of traders because there are another group of traders that are very aggressive. So as the price consolidating like this right now, some traders will already place orders above the consolidation session here to buy. In the first video, I revealed to you one secret about trading where there are orders. If you have plenty of orders somewhere, the price will go there and fill them up, all right? But if it's not supported by fundamental, or the dangerous trader want to sell them. Suppose you were here, you place order here, 10 people above this level, or you place it above the when it was here, you see 10 people above. Look, you just went above it. Breakout, yes or no? It's a breakout. All right, here you did. Just come back now, cancel it. Fundamental not solid, market environment not solid. 2007, 2008, a bearish season. All right, just bring it down. All right, so the first wave extension can be tricky for a lot of traders. And the best scenario, as always, how do we avoid mistakes? We use the market patterns, rising channel. So it's bullish, be patient. So it break out like this, okay, watch it, wait for your pullback, all right? All right? If it will pull back at one point. If it's going too fast, and you want to trade it, day trade it, go to the lower time frame, at least on your 15-minute, 30-minute chart, you will see a channel in place and you will see a kind of pullback at least. If you don't see any pullback at all on a 15-minute chart, drop it down to 5-minute chart. You want a pullback before you enter the trade. Impulsive move, pullback before you enter. All right? So, as you break out of the consolidation like this, we say this is a fast wave. All right? Now, we are watching it. All right? One thing I need to mention to you also, like you can see here, Cisco went down 1, 2, 3, all right? In fact, you see it went a bit messy here, but the move, in fact, you see 1, 2, 3, down here. And then it went horizontal here. This is what we are talking about, okay? When this is a bit messy here, blah, blah, blah. And then from here, it went 1, 2, 3, up again. And then it went down again, 1, 2, 3 again. All right? Now, what's going on? All right? So if you're going to have the first wave, we want a correction to be completed first. Is the correction completed? Yes. Okay, we tick the box. So first wave, if you count the first wave and you notice that the correction is not completed, don't label it first wave. So we want to verify first that the correction is completed. All right? So because of the earlier wave cycle, there was a multi-wave, there is a correction, and then we see now a first wave again. So, as it comes out of the consolidation zone, we see the first wave. If it pull back sharply and retest it like this right here, we are watching it. We are just watching it. All right? If it's going to go up, the common sense trend line, what is a common sense trend line? So, suppose you were here, it went up like this, and you want to buy. Okay? It must come out, break at least the common sense trend line. This is the common sense trend line. So don't buy below, okay? Don't be aggressive and say, I want to buy here. This is a pullback. Yeah, okay. Common sense trend line, kaput at least. Okay, if it's going to go up from here, it must go in a rising channel, all right? At least above a rising channel. So prior break above it, okay, you retest it, all right? If you want to buy above a rising channel in a bullish zone. All right? So the first wave extension, the first wave will be formed of a 5 wave, which means the price struggling to come out of the consolidation zone will come on 1, 2, 3, 4, 5. Trader will think that an earlier wave cycle is completed. Yes, it's completed on that time frame. But because a bigger cycle is about to begin, the price will pull back again after the 5 move. Okay, so we see 1, 2, 3, 4, 5. We think that the annual wave cycle is completed, and then we see a pullback. But in fact, this pullback, this is the second wave now. Now the third wave is going to be underway. But because the first wave has been extended, all right, traders are thinking that this move down is a correction. All right, but as the price come out of the consolidation zone, be very patient. Why? You should be patient. Because the market pattern that we have in place was horizontal channel. All we can do, we can wait for a new market pattern to be in place. You want to buy, you want to see a rising channel. So if you can't see it on the monthly chart, you can go to the daily chart, on the hourly chart if you want to buy, and look for a rising channel. If the price out of the rising channel on the hourly chart, on the 15-minute chart, on the 30-minute chart, well, don't buy again. All right? as always, one will check the fundamental. The best thing to do if you want to buy stock after the first wave, you want to verify the fundamental thoroughly. If a stock is undervalued, all right, in a sector that is bullish during a viable market environment, you can go and buy and hold. You don't want to trade it. You want to have a real portfolio and you buy and hold whatever happens, because you know that this stock is truly, truly undervalued, below its fair value, has been discounted 75%, and the market is bullish and the company is gaining market share, but it's not yet reflected in the price. So though Cisco went down big time, is consolidating, this is the best time now to check what's happening with Cisco. So we go to Google Finance, we check the economy news about Cisco. What's happening? We are talking about Cisco, we are talking about Wi-Fi, we are talking about routers that we are using for internet. What's the future of this stock? What is the management? What's going on? Who are the competitors? What's going on? And you go from there and you buy and hold. Not for 1 year, 2 years, maybe 3 years, 5 years. All right? So the first wave breakout is a bit tricky. Why? Because of the second waves. The pullback that we are expecting, so though we draw a wave like this, 1, 2, 3, 4, 5, it's not always straightforward like this, can be messy. So as we see the first wave like this, we want to analyze what is happening during this pullback. Now, the pullback will be finished when the wave pattern, talking about corrective wave, is completed. We are certain that the corrective wave, a corrective wave is completed, yes, and we receive a buy signal, we will buy. So the drill will be like this: a breakout, a corrective wave is completed, and we receive a buy signal. Let me say this again. So a breakout, a price break above a consolidation level, and a corrective wave pattern is completed, and we receive a buy signal, we will buy. This is how we can avoid the first wave breakout. The first wave is during the uptrend is the activity of the smart money that were analyzing the stock, that have noticed that the stock was undervalued, and they bought it at the lowest price. As the price was oscillating, they were busy buying, because when the brokers want to buy, they don't buy in one go, in one day and finish. They buy gradually. So as they know that the fundamentals are solid, that this stock is due to go up, the sector is due to go up, fundamentally speaking, all right, and the stock has been discounted, they know that this stock, in fact, so the analysts will upgrade the stock. They will say that this stock can go up to $50. That Cisco recently, they were giving the price of $25 to $30, Goldman Sachs, and all the rest, they were giving the target price. So you see analysts will come out and upgrade the stock. But sometimes the stock will be struggling, oscillating ups and down, because sometimes you see bad news, good news, bad news, good news, though the analyst forecast is already in place, and the company is gaining more market share. The sales are not reflecting at the moment, the bullish sentiment that major market participants have towards this company. And you'll be thinking that the stock is going to go down more. As you can see, for many years, for 2001 up to 2013, more than 12 years now, this stock is just going horizontal, all right? So when we see the first wave, we can just what I call the primary trend line, which means we join the low of the first wave and the low of the first wave. So for instance, if you are here, you can draw the primary trend line. So if this is, you see here, this is the low of the first wave, you pull back like this, you want to buy, so you will join this point. Are you with me? You join this point and this point, because you think this is the second wave, and then you join this point. Now, if you receive a buy signal here, you will buy, all right? Suppose you were wrong, all right? So your stop loss will be below here. If you were wrong, the price went up, you were happy, you say, yes, George, I catch the trade in your way. But because you didn't know anything about the zigzag pattern, and then they start pushing down. As soon as it did below the trend line, you will come out. So the primary trend line will also assist traders to filter out false breakout during the first Elliott wave. So price went up, break above the consolidation zone, pull back. You think that this is the end of the correction, join this point and this point. And if you receive a buy signal here, you buy. But if the price dip below the primary trend line, you will come out. All right? The primary trend line is by joining the low of the first wave and the low of the first wave. So if you knew that, okay, it's completed now at this point, 1, 2, 3, that's the primary trend line now. So you will look for opportunity to buy here. And you know that there's a resistance here, you must acknowledge that. Your stop loss will be below here. So if the price dip below again this primary trend line, you will come out. In all cases, the primary trend line will allow traders to make excellent breakout trading decisions. So as the price break above a resistance level, there's a high chance the price will validate that resistance level. Why it's so important to wait before one jump into a breakout trade? Now, ladies and gentlemen, I need to say this. I need to get this out of my system, all right? I've seen it all the time, whether on a 3-minute chart or on a 5-minute chart. Sometimes some of these breakout traders give us headache. Headache. Why? Because anytime a price goes above a resistance level with some crazy algorithm now in this market, it's becoming very, very wild, like the wild, wild west. It's crazy. Now, price goes above a resistance level. It's a resistance level until that resistance level is converted into a support level. How the price convert into support level? By retesting it and finding a support there. So you see here, as it break above the blue line here, are you with me? All right, it break above it. This level here is still a resistance level because you see it went up, it touched here. So we will expect it as it break above here to validate this resistance level, to convert it, so to speak, into a support level. How? By pulling back and to return back above it and find a support. Here in this case, it didn't. It just did below it and retested it with the wick here and went down. Now, sometime, like here, where are we? This level here. You see here, this was a resistance level. Let's draw a line there. Are you with me? So we were here, okay? Too many drawing, but that's okay. It means that you are focusing if you are following me. So here it went up and then pulled back. This level here is a resistance level. The prior move was bullish and then it pulled back. It almost canceled it. So now, you see, it went with one candle tall like this on a monthly chart, okay? But if you look carefully, are you don't go away. Here, this one. We are here, okay? Suppose you were here and this monthly candle closed. So you'll be saying to me, George, where is the break? Where is the pullback? How do you handle that? Now, because you're on a monthly chart, the monthly candle is closed, and you say, okay, it's a breakout on a monthly chart, okay? You want to buy? You can go to a lower time frame, daily chart, hourly chart, 30-minute chart, whichever you want to use, and you will see a pullback. Though on the monthly chart here, you can't see a proper pullback on this chart, there was a pullback on a time frame where trader entered the trade before it went up. All right? So you want to see a pullback, which means a validation. It can be even on a 3-minute chart. You will see sometimes on a 3-minute chart, a key level from a higher time frame. If you draw it like this on the 3-minute chart, you see the price will go above it. Okay, on the 3-minute chart. Slowly, it may retest it. But if you are looking, for instance, on the monthly chart, you may not see a pullback. But on the 3-minute chart, there was a pullback, and the market does not want to pull it back more, and they take it away. All right? So this is just a few tips and tricks about how to trade breakout after, the first wave extension. As I explained to you, you can wait patiently also, because if you don't know that it's going to be extended, okay, so you went like this up, and then you pull back, okay? What do you need to do? Draw the primary trend line. So you join this point and this point. So you have your trend line now. This will allow you to avoid mistakes, okay? So you decide to buy aggressively, all right? So you say, George, I'm not going to wait. I'm going to buy straight away because this is the lowest risk point, so you buy. But you will place your stop loss below the primary trend line. If it did below it, all right, and you know that he's staying below, he's finding a resistance below the primary trend line, don't force it, just come out. Which means that maybe the second wave is not yet completed. But suppose, ladies and gentlemen, he ran away, all right? So he pulled back, he tested, you think that it's going to go down more, he didn't, and then he ran away, all right? Where do you need to buy again? So, all right? Let me remove Saline and continue with this important discussion, all right? I'm going to remove Saline, and I'm going to say something very interesting, all right? Stay with us, because you are Elliott wave practitioner, and I want you to pay attention to this because it's very, very important, all right? All right, going to remove some line, and I'm going to continue this discussion because it's very important. And if you are getting tired, you may pause the video, all right, and come back to it, all right? Go and drink something, and come back to it, all right? Stay with me, because you are my friend. I want to share this information with you today, so you may start trading, okay, like the pro, okay? All right. I'm clearing my charts a bit so we can all see everything that I'm talking about here. And if you do not understand anything, you can replay the video and take it step by step. But if you are tired, do not watch this video because otherwise you're not going to get anything out of it. All right. So suppose you were here and you see breakout, then you think that it's going to go down more. You were very careful. And you say, George said to me to be careful here. I'm waiting for a second breakout, and it didn't happen. Where can you buy again? So you see here the RAM, you see, wow, I miss it, all right? You see, I miss it. The second place you can buy is above this level. This the top of the first move. So, boom, you see here? And it pulled back like this. Some conservative traders that do not want to chase the second wave because they know that can be messy will buy above the high of the first move. So it came out of the thing like this, as it did here. Suppose you were here, and you don't know anything about Elliott wave pattern, and you think that this is the first wave, okay? So you say, all right, this is the first wave. Now, instead of buying, okay, at the end of the second wave, you can decide to buy on top of the first wave. All right? Instead of buying at the end of the second wave, you can buy above the high of the first move. So you were here. All right? You come out of the consolidation zone. You know it can be messy sometimes. Or the second wave can cancel the first wave, which means return to zero. Fundamental are weak, market sentiment is not, it's bearish, and it break out, and then quickly cancel. You say, what? I was thinking to catch the third Elliott wave, or maybe MACD quickly cross above his signal line. You say, yes, that's exactly what I just said. Okay? But you can decide not to buy, to take the risk during the second wave, or maybe you don't know whether the second wave is completed. You can wait for it to go. So if it goes like this, pull back, and it starts running the way you want to buy, draw the line above the first move like this, and switch to another lower time frame to zoom into it, looking for a pullback to retest this level, because this level here is a resistance level. We can zoom into it on the 5 minute, on the 3 minute, even on the hourly chart, waiting for a pullback, and from there we'll enter the trade to catch this fast move. Because you're on a weekly chart or you're on a daily chart, and you see that, you say, what? They just take it away. I missed the third wave, George. No, you can still re-enter the trade, join them if you draw this line, okay, and look for opportunity to buy here. So the first wave breakout, one can avoid making a mistake if one decided to buy above the first move that came out of the consolidation. So it came out of the consolidation zone. You know that the second wave can be messy. You may draw a line above the high of the first move and look for opportunity to buy above that high, provided that that resistance is converted into support level. We'll do exactly the same thing. I mean, we'll do the opposite, all right, in a downtrend. So the price out of a consolidation zone. So you see the first move, because the signature of the first wave is to come to break out of a consolidation zone. So you come out of the consolidation zone, you say, George, I want to catch the third wave. I want to catch the third wave. Well, in a downtrend, okay? So you may decide not to enter somewhere here to sell. You may decide, you say, that's the first move down. You may draw a line here at the low and wait for it to break above it and zoom into it to sell it after, okay, it goes, okay, below this support level here. Instead of, okay, selling it, okay, at the end of, okay, the rally. The reason is at the end of the second wave. Now, by buying at the end of the second wave, provides you with a low-risk entry point, and also a low-risk entry point and a higher profit, because you are buying at the lowest point and you're going to sell it at the highest point. Compared to the person who is selling here, you are likely to make more profit because you are already in the trend from this point as it's going down until this point. But the person who is selling it below this level does not want to get into trouble. That's why he or she is saying, if it's truly a third bearish wave, the price must go below the low of the first wave. If it's truly a strong third wave that you want to catch, you can perfectly enter the trade at the low of the first move or the first move. Why am I saying the first move? The reason is that when we are talking about an extended first wave, an extended first wave is formed of 5 waves. So this is a first move of first minor wave of the first wave, and this is a second minor wave of the first wave. So instead of buying at the end of the second minor wave of the first wave, of the first complex wave, we can buy above the high of the first minor wave of the complex first wave. On the other hand, in the downtrend, instead of selling at the end of the second minor wave of the first wave, we can sell below the low of the first minor wave of the complex first wave. Ladies and gentlemen, it is time to stop this video, all right? I hope I've said enough, and I'll explain myself to you, so how you can trade, okay, the breakouts during the first wave, especially when we are dealing with a complex Elliott wave. I hope you have learned something from this video also, and we put into use, okay, to make excellent decision. We'll continue to put video on YouTube, on our channels, on our website, to educate traders, okay, to share, okay, our trading strategy with traders. When it comes to Elliott wave, I do not retain any information. I share everything with traders on our website, on YouTube, because the more traders understand the wave principle, the better market will have. An orderly market will provide more opportunity to everybody. That's why I leave this discussion open, and I do not hide anything when it comes to Elliott wave. I do not have any secrets coming to Elliott wave. I share everything on the open market, like open platform, like YouTube, Facebook, Twitter, and our website. And I encourage traders also to share our videos on the social network and to share with other traders so they may also understand the market. Why? The reason is that since 2008 up to now, we have seen a lot of distortion in this market created by a lot of algorithm trading software, and also due to ignorance of some traders. A lot of traders use MACD, stochastic, and they do not know anything about the price structures. The Elliott wave traders, the Elliott wave theory, allow market participants to avoid the fast fight in the market and to create a better market environment, an orderly market where a lot of traders will make profits, all right? But when the market is distorted, even the most intelligent traders can lose, all right, which is not very nice, all right? That's why we are encouraging traders to share our videos, to share Elliott with videos on YouTube, not only our video. There are other, fellow traders posting video. Share them and put your comment below. Do not spam. Put in the comment below our video, all right? And we can leave this discussion open to create a better market environment, all right? Until the next time, enjoy yourself and be very happy. We are the TSTW SYS 008 traders. Speak to you soon. Voilà, c'est fait.